This is the Real Estate Investing 365 podcast, your go-to source for real estate investing strategies so you can start living the life you want and get where you want to go. With your host, Justin Hanna.
What's going on, everybody? Welcome back. Another episode. Today we got with me Stefan Tsvetkov. Hopefully I said that right. We were just talking before we got started here, and I was like, man, let's make sure that I can say your name correctly. But Stefan's here. He's from
Perfect, Justin.
All right. He's from New Jersey, right next to New York, I guess, right across the bay there. I'm not super familiar with the area, but I assume it's kind of close, right?
Yeah, it's the river. It's right across the river, pretty much. Yeah. Mm-hmm.
Okay. He's a financial engineer working in the derivatives trading area for a major insurance company. He's in real estate, though. He's an investor. He's got a couple multi-family properties. He's the founder of Envy Analytics. And the reason I had him on today is, for one, to kind of share his story, how he got started. And for two, he put together a really good analysis piece of whether the real estate market is overvalued. And he goes into some different locations and states and the values, whether undervalued, overvalued, and things like that. So Stefan, thanks for being here. I appreciate it, man.
Yeah, that's good. Thanks, Justin. Thank you so much for inviting me. I started in 2017 as an individual investor then. So I've been buying basically 3 and 4 unit properties, close to New York City and upstate New York. So that has been my personal investment strategy, but recently I've been moving more towards out of state syndications, things like that. So I've been doing a lot of analysis on that end. So trying to understand in the current market, which areas are undervalued, overvalued, etc. And where one can invest and have a business continuity in the event a downturn potentially happens, if it were to happen. So yeah, that's a quick intro.
Cool. Okay, perfect. So to give people a little bit more background, when exactly did you get started in real estate?
Right. Yeah. So I got started in the beginning of 2017. So
Okay.
the first, my start was with purchasing a 4-family property in New Jersey. So that was a good, I was happy with it. So that was in Hudson County, New Jersey. So the most nearby part. And it was, cap rates there tend to be not too high, but this one was really, really good, actually. So I was very happy with it, and I still have it, actually. So that was that start. So I would say at the beginning, I was more looking for cash flow, surplus cash flow, just get a certain cash on cash return, things like that. And then as I progressed, meeting with other investors, I started looking more towards value add. And then in the more recent period, I started looking, okay, now I have those two things, but in the Northeast, appreciation hasn't been the best. We have Colorado, we have Texas doing much better. So let's look for other areas that are, with better price performance, that are not overvalued right now.
Okay. So that first property that you bought, you bought it to live in it, or was it strictly a rental property?
The first property, initially I bought it to actually live in one of the units, since I happen to like that unit, by the way. And then I did end up moving out down the road. So it's currently an investment, yeah. Mm-hmm.
Okay, perfect. It's like what we call a house hack, right? Where you live in one
initially,
unit.
Yeah. Initially it was like that. And it was basically living rent-free for 100%, yeah.
Yeah, that's good. Okay, and that's kind of what you have to do, I think, over in that area where you're at, is if you're going to buy a multifamily property, a smaller one, it seems like a lot of people end up living in them because the prices are so high. So you can get into them for less money and cover your rent or your own mortgage with the rents of the other people, right?
That's correct. Yeah, that's correct. And as you know, also, that was my only opportunity to do owner occupied at that time, since I happened to actually really like one of the units there. Mm-hmm. But besides that, I would say, it's a great, I would say owner occupied is super good financially, just because on the financing side, okay, it's not just that you have a better interest rate, but you also, and lower down payment, let's say initially. But also you have, further capacity, because actually filled in my down payment up to 20% at some point later, actually. But the thing is, I was able to pull out, some of the equity, just the home equity options are exceptionally I mean, I would say they're kind of lenient with some of the credit unions out there, like in Virginia and some other places. So one can definitely like boost cash on cash super much. I think anywhere between 25% and even 100% cash on cash is not unheard of, you know.
Right. After you,
turnkey, yeah.
yeah, no, I definitely agree. So the good thing is you got started in 2017 when there were so many people that kind of like stopped their real estate investing in 2017 because they thought it was just, you know, getting to the end of the cycle, but it's continued to go up. So I guess that's kind of what led to you doing this analysis, and you're kind of obviously analytical and, you know, financial engineer. So you can run all these math equations or whatever you do, you know what I mean? So that's kind of like led up to this, right? Because we're coming to this point in 2020 where people think there's a downturn coming, and maybe there is, maybe there isn't, but that's what led you to look in other places and run these numbers, right?
Yeah, that's correct. I would say that's a fair summary. And, you know, especially subsequently COVID is an extra, you know, like, and having an officially declared recession as of this June, you know, that was like something to consider. Now, of course, it doesn't need to have a particularly big impact on real estate, you know, but that was, yes, definitely prompted me to look into, okay, if we're at peak of cycle, can I invest anywhere and, you know, not lose, let's say 10, 15% of the price, or, you know, even if it's not a huge drop, but, you know, it's you're levered 10% down is not that great. So that was some of the motivation. Yeah. So I've been working more towards out of state and like with partnering with people, doing syndications.
Okay, so what was kind of some of your findings? You know, I'll just get right to the question. Does your findings show that we are at the top of the market and it's about to have a big correction, or what do you think about that?
Yeah. I mean, I would say, I mean, if you would allow me to share my screen, I can show a slide on that.
Yeah, so anybody that's just listening on podcast, he's going to share a screen, but we'll try to talk through it. And then if you want to see it on YouTube as well, the video will be up there also.
Yep, exactly. Sounds good. And yes, so this is, so, you know, for whoever is watching, so this is like a map view of where I see valuations currently. So when I say valuations, actually what I do is, this is percentage deviation of historical price income ratios.
So what'd you say? This is a percentage of historical price increase ratios?
Yeah, this is their price income ratios, let's say in Colorado.
Oh, price to income ratios. Okay.
Price income ratios, price income, let's say have been at a certain level, and the current level in Colorado is at 13% more than that. Okay. So this measure, the reason why, I mean, I tested out different metrics actually. The reason why I did this one is because in 2007, this metric was super highly correlated with the drops that happened. So at the moment, this is, that's what it's showing. Unfortunately, I know you have what
I'll do is maybe you can can you share this with me, and then I'll put a link to it in the show notes or something to where people can view things like this. So what the map is showing is it shows a map of the United States, and then each state has a percentage in it. So for example, Idaho, where I just moved to, has 22%. So I would assume that means that the price to income ratio is 22% higher than the average or what it has been in past years, right? Whereas California's 2% it shows, but you look at like Wyoming's -2%, Kansas is -4%. Where do a lot of people invest? Like North Carolina, a lot of people are down there, -2%. Places like that. So that's a good representation. So how far back did you go with the price to income ratio average?
Use like FHFA data. So that's like since 1975, actually.
Okay, so there's an average since 1975, which was like,
no, it's a trailing for this one. It's a trailing average. That takes like some testing to determine. I think here I use a 20-year trailing because it seems to correlate highest. Because the thing is that price income ratios, they don't stay the same. Because if you think about it, like how would you be able to predict a drop just based on incomes? It's not sufficient, right? There has to be something more to it. But what happens is that price income ratios, if you test it, the actual deviation from that predicts the drop super well. So why? The reason is because they trend higher with some of the other metrics like population and housing supply. So what happens is, for instance, let's say in Texas, let's say Texas is 11% overvalued, but its valuations increased by more than that from, let's say, 10 years ago. But there is a housing shortage in Texas. The overall levels of the market, of the valuations in that market moved up. And so the ratio is actually less than, than it could be, the 11%. So this is like this kind of thing. So it's reflective of, it's really based on price income ratios, but it's also reflective of housing shortage and any other factors that could go in it. So that's that. And
so I guess the higher the number on this map, more, like Idaho, it seems to be the highest on the whole map.
Yeah. Unfortunately, now, I mean, it's not like super terrible, but right now, unfortunately, Idaho happens to be the most overvalued, and there are 8 states that are overvalued. Only 8, more than 10%. Okay, so everything else is, is less, either less overvalued or it's just undervalued even.
So as a
it's the end of March was this, because that's like where the data goes up to. Prices haven't changed all that much as we know since then, in spite of COVID. So
okay, so for Idaho, you're saying, part of the reason I do know why Idaho prices have gone up so much is because, I mean, so many Californians, Oregons, and Oregonians, or whatever you want to call it, and people from Washington, they've moved to Idaho recently, and they sell their houses there, which are super expensive, and they have a ton of excess cash, and they move here, and so they're pushing the prices up, but it's primarily new builds, and they're building houses like crazy. So I guess when you say it's overvalued, it's overvalued for what, like primary home ownership or rental property ownership?
Well, this would be both. So this would be just, let's say, like this uses price history from FHFA. So I would say what it's not the larger multifamily, because there isn't enough data on that. Like, it's not like 50, 100 unit buildings, we don't have the price data too well there, but it's anything that is, any like single family. This is mainly single family and small multifamily. It's just price histories and like either Zillow. I did the same study for Zillow as well, or FHFA.
Okay. So as a country as a whole, it actually doesn't look like that bad. It only shows a couple states.
Yeah, just there are a couple of states. So, we have like Florida, Texas, Colorado, Nevada, Arizona, Idaho, Washington State. And that's about it. Yeah, actually, that's about it. It's not bad. It's very fairly valued. And there are other countries. There's an economist that did a study that uses like a similar kind of approach, but he uses several metrics actually. And then he showed it for Scandinavia. He showed it for Australia, UK, Canada. Canada is like super overvalued. It seems to be a bubble over there. And so some of those other places. And UK is a little bit more moderate, but still overvalued. But US, like he had it at like 110%.
Okay, and
so that it's not looking too bad. And then the other thing is this, I would say, if Texas is overvalued 11%, does it really matter now? Not necessarily, because the only time valuations would matter is at peak of cycle. And until then, it's going to be driven by momentum. And I didn't I didn't want to be like showing like too much, like boring people with data, etc. But I did like an autocorrelation study for momentum, like where, prices this year, prices last year, let's say influence price performance last year, influences price performance this year. And it's mostly like most of the time, real estate is super momentum driven actually. It's like there is past price histories determine the future actually, which it shouldn't be in an efficient market, but that's actually what happens. So there was like 70% autocorrelation in most states, like Colorado, etc. So if let's say Texas may be overvalued, that's still going to be the best performing market likely, and may get more overvalued, or if incomes perform the same, may stay the same overvalued or less, however.
So real quick,
but only it's going to drop at only it's going to have an effect at the peak actually.
Okay, so just so everyone's clear, and so I'm clear myself, when you say overvalued, that means that the prices of the houses are going up more than the amount of income that people are making. So maybe they can't afford to
Correct.
live in the houses.
Yeah, correct. Then the amount of income, and inherently also then the housing shortage, then the population growth over the housing supply inherently as well, even though it's not factored directly.
Mm-hmm.
But since the historical level uses this trailing window, it kind of captures higher and higher level of valuations. And then if the current valuation is even higher than that average, it kind of reflects, okay, housing shortage happened, for instance, in Florida. There is a lot of housing shortage the last 10 years, but it's still 11% overvalued. It probably would be 20% overvalued if the housing shortage was not accounted for, you know.
Okay.
So it's kind of, yeah, it's based on incomes. Yeah, it's exactly, you're right. But indirectly, it reflects more. I would say the perspective, it's more investors, I think, shouldn't look at just prices, because if you look at prices, it doesn't mean anything. First of all, there is inflation, there are things like that.
Mm-hmm.
So the goal here is more like, instead of looking prices, just look at some kind of normalized prices.
Mm-hmm.
So that's what it is. So let's say price income, and then once you're in this space, everything makes much more sense and gets like much better.
Yeah.
And then, and similarly, for instance, if you want to look at, let's say, did the market perform well? Because let's say, look what I did, just when you were saying which were the best performing markets, let's say Idaho did really well, right? So for example, this is just purely the price changes. Just one moment, where did they have that one? Yeah, those were actually the best performing states. But here I took it since the previous peak in 2007. So ones that surpassed their 2007 level, let's say.
So wait, what is this one? This one is a map of market performance by U.S. state, peak to peak price, 2007, 2009. So this is showing is this the same number, like the income to price ratio?
No, so this would be just which markets did well in price terms. Since the 2007 peak until now, it's actually peak to current, you can say.
Oh, yeah. Okay. So which
just the price performance everyone sees.
This is saying which states have had the best increase in home valuation?
Yeah, not in valuation. Yeah, just actual price. Yeah, actual home prices. Exactly.
Actual home price.
So let's say Texas is 56% above its 2007 level. Colorado. It's just showing kind of some of the best performing states like Texas, Colorado, Idaho.
Mm-hmm. So it says Nevada is probably the same price. The houses are the same price now that they were in 2007.
That's correct. Yeah, that's correct.
But in Texas, houses prices are above what they were in 2007.
Yeah, by a lot. Yeah.
By a lot, by 56%. So I guess what that means is that income has gone up drastically there. So the price increase, everybody might be afraid that, I'm paying more for this house than people paid in 2007 at the peak. But it doesn't really matter because the incomes are all going up, which means the rents are probably going up, which means for buying rental property,
on that, you're right to an extent, but on that question, I would say it's, let's say Texas prices are 56% above their previous peak, but they're 11% of that, let's say, is an overvaluation. So yeah, mostly incomes have grown a lot, of course. There is a huge population growth also over there, and incomes also have grown. But most of it, of course, it's not. It's like a fair valuation, most of it, but has gone a little bit overvalued. But it just serves to show that some of the states that are currently overvalued are actually states that, they performed really well. But since we don't know, but maybe we're closer to the end of the cycle, they have become a little bit overvalued at this point.
Yeah.
But the states of Texas, Colorado, Idaho, and etc. Now, it's interesting, actually, one thing why I said it's good to look in normalized price terms, because if we look at Nevada, right? Nevada was flat versus 2007 in that price performance that we saw. But then I actually improved that, and what I've been doing since then is computing when the fair valuation has been historically.
When the what valuation has been?
The fair valuation in each region.
Okay.
So let's say in Nevada, it has been in whichever time. Could be in 2009, could be a different year, etc. and looking at the price performance since that fair valuation, because it's also Nevada and Florida and Arizona, they were super overvalued in 2007. So yeah, they're at roughly at those prices right now, or even below them.
Mm-hmm.
But that's just that's also kind of noisy because it was just super overvalued back then.
Do you have a map that shows, or a list that shows what year was the fair valuation year, like when prices were at a fair level?
I don't have it here, but yeah, I do have that. I have like the history of valuations, going back, across all regions. And I also do that at the county level, actually. Because, it's not like super useful to myself, okay, just to look at which states. I'm actually trying to select markets based on that.
Oh, okay. So you have that somewhere. Okay. That'd be interesting to see. So, my partner and I were just talking about this because we find ourselves like, writing offers all the time on properties here in Idaho. And it's so hard for us to swallow the fact that the prices are so much higher than we were buying them just a couple years ago. But the funny thing is like in 2017, we were saying, man, I can't believe somebody would pay $400,000 for this fourplex.
Mm-hmm.
Well, last year I was saying, I can't believe somebody would pay $500,000 for that fourplex. This year, people are paying close to $600,000 for the same fourplex. And I keep thinking, well, I wonder when the point is to like call it and be out, because we've bought stuff since 2017, but a lot of people haven't. So, we should have bought it at 400 and we should have bought it at 500, and maybe should we buy it at 600? I don't know. But as long as the numbers still work and you're still, cash flowing, right, and you're still meeting your cash on cash numbers and stuff, maybe it would work. But the main point is just to make sure you guys are running your numbers, and just because the overall dollar value is high, if the return is there, then maybe it's still a good idea, right?
Yeah. I mean, that is true to an extent. I mean, also, of course, you're right. Also, the overall dollar value being high doesn't mean anything because we don't know how much incomes grew. Because, for example, let me show you, there is at the cities level, there is a very interesting perspective. So take a look at Denver, Colorado. So Denver, Colorado, this was the best performing city out of 800 cities in America, 800 with more than 50,000 population. So it's 79% above its 2007, let's say, level.
Mm-hmm.
But Denver, Colorado is actually fairly valued at 0% right now. So prices grew so much, but it has all been, supported by incomes. It's just the area has really grown in genuine terms. So incomes, apparently exploded as well over there. So it's actually not overvalued. Now, the rest of Colorado, most other cities actually in Colorado, they are overvalued, around 15% overvalued. So I would say it's not super safe in Denver, because if the state is overvalued, I would think, it's a little harder to predict like smaller geographies. Anything can happen there, at least from what I'm seeing. So that's that. But that's one example of a place that really, went, super much higher in prices than it was, and it's actually not overvalued. And another place, let's say in absolute affordability, everybody knows San Francisco is really not affordable, right? But actually, what makes a place overvalued is also not, I would say, affordability itself. It's when affordability shifts from its previous levels.
When the what shifts, you say? What word?
When affordability.
Oh, yeah.
Yeah. So let's say San Francisco is not affordable compared to, I don't know, maybe Nevada, places in Nevada or something like that, right? Mm-hmm. But San Francisco has always been not affordable. And so that is what drives a subsequent drop that may happen at peak of cycle, whether, it became, not sustainable, even further not affordable, let's say. Mm-hmm. So that deviation is what drives it. And for that, actually, I did. So this is, so this is, by the way, the kind of justification I did for this study. I just because I have the current valuations, but what I was trying to verify it with what happened in 2007. So those were the most overvalued markets in 2007, actually. You see, it's like much more overvalued than now, in the sense like California is like 68% above, and Nevada 49, Arizona 55, Florida 61, and there are other places as well. And so what happened is that these valuations that I compute now, the exact same metric, it correlated 83% with the actual drops that happened. So for example, like the overvalued markets were these, right? So we have, let's say, California at 68%, down to New Hampshire or down to Vermont at 11% overvalued. And median, these overvalued markets were 26% overvalued, let's say, and the median drop that happened in overvalued markets was 22%. So it's not that in 2007, okay, we had all that finance, mortgage-backed securities, all that stuff. And we had also people moving, like all kinds of population shifts. Let's say there was tons of influx of population into Nevada. Mm-hmm. In spite of that, Nevada dropped 56%. So the drops at peak of cycle, I would say valuations are not important at all in intermediate cycle. They don't matter. It's just a risk management measure. Whenever it happens that we reach peak of cycle, this is going to be driving the drops then.
Okay.
So that's exactly, yeah. And then what happened in undervalued is very interesting. They only dropped 4%. So undervalued states, that's the biggest crisis in real estate history recorded in US, right? And the prices, if a market was undervalued, 4% drop, that's it. It's like super immaterial. And actually 4% was that's how much incomes dropped in US post 2007. So it's actually, one can say, high level, one can say valuations didn't drop. It's more like just an income drop. That's it.
So it looks like these states that you're showing here, you show Kentucky, Arkansas, Louisiana, Kansas, Indiana, Texas, South Dakota, Iowa, Nebraska, Oklahoma, North Dakota. Mm-hmm. Those states almost didn't get affected hardly at all from the recession. And maybe that means that, they're not going to get the appreciation, except for maybe Texas, obviously had a lot of appreciation, but those seem like pretty good cash flowing states, I would imagine, is what those are.
Well, okay, you're right. This is one driver for a market. If a market is undervalued, you're right, that correlates with that often maybe a cash flowing market where prices don't perform so well. It's more of like a high cap rate area, things like that. You're right. So there is part of that. So that would be more like in areas like Arkansas, Louisiana, et cetera. But in this case, not really, because it's not necessarily the case that the market performs not so strong in price terms. It could be that, it performs very well, but there's no frothiness, or how to say, it's like there's no overvaluation. Incomes have also done well. So for example, actually it's very interesting to see you're right, what happened with these markets afterwards, because Texas prices exploded. North Dakota has been among the best performers as well. So if we look at like the next, I think it's right here. So we have North Dakota dropped 0% back then, and yet it was one among the best performances, 49% since the peak. So it's not like if one invests in undervalued markets, those would be weak markets, not at all. And in fact, what I've been suggesting and what I've been doing with my partner for market selection, actually trying to select, so like this slide. So the best performing markets that are undervalued. I don't believe one should just invest in undervalued markets, because you're right. Like a market may be undervalued just because it's, it's stagnant or how to say, just prices are not growing much. It's more of a cash flowing area, things like that. I don't believe in that. I just think that, at the current points in the cycle, it's safer to invest in undervalued markets, but ones that have performed well, ones where, prices have also done well. So this is kind of more of the balance. If we're at the beginning of the cycle, then you don't care about valuations. One doesn't care about valuations at all, And then just whichever, like population projections, job projections, things like that. But at peak of cycle, what I see is none of this was able to predict the 2007 drop. What was best able to predict the 2007 drop is, what I showed in slide 13 right here, 12. So that's what was able to predict. So that's what happens at peak of cycle.
Mm-hmm. So for a takeaway on this, are we at a peak of cycle? You don't know yet.
I don't know yet. That's a different topic. Yeah, I don't know. But exactly. So that is, nobody can tell, right?
Yeah.
But if the question is, let's say if one invests in, I don't know, in Texas now. Okay, where is it? Like, okay, let's say one invests in Texas or in Florida. Okay, it's not super much overvalued, but if a peak happens, those could be the drops to happen actually. So that's straight out of a regression based on what happened in 2007 and the current level of valuations. They're just a simple linear regression.
Mm-hmm.
That's what the drops are. I'm not saying the drops are going to happen now, no. But let's say a peak in the cycle happens 3 years from now.
Mm-hmm.
Let's say the markets have the same level of valuation then. Let's say, then that would be my best estimate for the drops actually.
Okay. Yes, I understand that. So you can project what the possible drop would be. So you can kind of go in and pick your market and you can hedge, run your numbers with the potential drop in your numbers.
I mean, it's also worst case scenario, but also let's say if one invests over a 5-year horizon, maybe let's say if it's a syndication or dependent, right? Let's say it's a 5-year horizon, then I'm thinking, okay, now it's gonna go really well in those markets for 2-3 years, but then at some point, then that may happen. So it's also possible that prices do not correct. The other thing is in 2007 was a correction scenario. So if a correction happens, then roughly those will be the drops, roughly speaking, at the state level. Now, if it's not a correction scenario, that's also possible. It's just in 2007, like almost all counties, like 95% of them corrected in price. That were actually overvalued. That's what I was looking at the data. It can be that, nothing happens. Can it that just prices continue to grow forever? A correction never happens. And let's say incomes, just there is a reduced growth in prices. Let's say those areas that are overvalued, maybe they would grow slightly less than they have grown now, and incomes will be growing more, and incomes will catch up, and then everything settles back again, and it's not overvalued again. That happened in Brooklyn last cycle, actually.
Okay.
So Brooklyn was super overvalued, and yet it's very kind of fairly valued now. It's not like that overvalued at all, just because, there are different drivers there. There is also some housing shortage effect, I believe, but also just incomes grow very healthily over there. And as in other markets post the crisis, incomes dropped everywhere pretty much, or in most places, but in Brooklyn, incomes continued to grow. And so that very super strong income growth made it that, the overvaluation got resolved over time. So that's possible now. It's more like, but then that would mean that the peak of cycle didn't happen. We just always continue to go up, right?
Yeah.
But this is more if there is a peak in the cycle, means the subsequent drop follows, let's say for several years, 3-4 years or whatever. And then over these 3-4 years, or let's say last crisis was 4 years and a quarter was the average time that it took for prices to reach the bottom, actually. A really long time, in 2007 and 2011, roughly. So I mean, then that would be, but hopefully it doesn't, because after all, now we don't have the difference. Then is, a lot of markets were super overvalued then, maybe that triggered certain processes. If there is no trigger, it can just continue like that. And the best performing markets would be, again, these overvalued markets then.
Yeah.
Because, they have the momentum. So they will continue to have the momentum, but it just would be a bit risky,
So where can people, so for some solid action so people can take, where is the places that, do you have a list of the best places to invest, or like the areas that you're looking to invest in as far as rental property? Which areas are those?
So there was some of like this list, for instance, was, now it's not like super exciting states you can see, but purely from the, one thing I want to say is that this list was based on, like I said, the prices since last peak in terms of price performance, but then I have since revised it from a fair valuation perspective. And that is more, I would say, like, even better. But these are, roughly like some areas where, okay, if one takes, for instance, the state of Indiana, it's still undervalued, but, price performance has been healthy. So it's not like an area that is depressed, such as what we have in the Northeast, such as Connecticut prices are like super depressed, and New Jersey is super depressed. We don't see these markets in this list.
Mm-hmm.
So they're not here. It's more like areas, okay, they did decently in prices. They're above their previous peak as well, but they're still undervalued. And there are some other markets, I think, like in Kentucky, I don't know, like I believe Louisville, Kentucky is still undervalued, let's say. There are cities, I can show some cities actually, maybe that's better. Yeah, so we have Pittsburgh. Pittsburgh is undervalued and has done really well in the Northeast. It has been one of the best performing markets in the Northeast. There is, well, I mean, I personally wouldn't invest in San Francisco, but technically it's still undervalued, and obviously prices there have grown a lot as well.
Mm-hmm.
There is Omaha, Indianapolis, so Louisville, Philadelphia. Those are some markets that they did well, and they're still undervalued. So from my perspective, these are the markets to invest in. Now, of course, if one is able to find the deal, build all the agent contacts, do all that, it's in the end, you're right. If you have a deal, you can have it anywhere.
Mm-hmm.
It's just now, let's say if you find something that's undervalued by 10%, but then the market also drops 10% during the life of your investment. It just kind of, makes it a little harder for,
mm-hmm.
To do work. Now, of course, then it's still one is doing, in that case, the correct approach. One always looks for value add, and that protects him from that drop. But it's just a little bit risky that, some of the work that one puts in may be kind of offset by, by the market. It's still ideal if the market also supports it, it would be better. So that's why, it kind of matters. That's why personally I look for, okay, I'm trying to find like obviously a deal and markets that cash flow well as well. But also thinking that possibly we're closer to the peak of cycle, I'm somewhat reluctant to invest in the best performing markets at this point. It's more of becomes of, one has to kind of go into a little bit of secondary markets in that instance, which is less exciting, but probably more prudent from a risk management standpoint. So
yeah, no, I definitely agree. Well, right on. Yeah, this is a lot of hopefully people were able to follow along a little bit. I know we had the slides on here, but again, it's on YouTube. And then where can people find this information? Do you have a website or a link or something that people?
They can reach me on LinkedIn. So that's my contact information. Feel free to share it.
Okay.
If anyone is interested in more details, I have a more detailed kind of PowerPoint as well, with like 80 slides or something like that. It has like a lot more statistics. I think that would be useful for people to see. So I think LinkedIn is the best way. My email address as well. I also have a meetup that I organize in New York City. It's called Finance Meets Real Estate. And I also have a YouTube channel recently. So those are some places.
Okay, perfect. Yeah, we'll link to all that in the show notes. And again, so if you guys want to see this, it'll be on YouTube or in the show notes. And you guys reach out to Stefan and see what else he has to say. So, hey, man, I appreciate you being here. It's good information. Hopefully people can use it as a good out-of-state investing tactics for a lot of people in the coast.
Yeah, thanks, Justin. That's great. Thank you so much for inviting me. It's my pleasure.
Right on. Have a good day.
You too.